you'll lose money trading if you can't control your emotions while trading live. In this video, one of our senior traders reveals the 6 must-have rules to help you do just that. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our desk so you can grow your trading account.
Nothing is more painful than taking one loss after another, being overtaken by emotion, and then digging yourself into a deeper hole by revenge trading. Soon, you're mired in self-doubt and you're a complete wreck. The elite traders in our firm see losses not as setbacks, but as opportunities to refine their skills. To guide you through this process, let's explore 6 fundamental rules to help you avoid these pitfalls. Rule number 1, emotional control. Recently, a new trader came up to me with a question. They shared a scenario where they got stopped out on a well-executed entry only to see the price move in their favor shortly afterward. Later in the session, they found themselves fighting the urge to trade outside their rules in order to make up for that missed trade. They asked what they could do in a situation like this. My advice, never trade if you're riddled with emotions. Take a minimum of a 10-minute break. The science behind taking a 10-minute break lies in the concept of cognitive fatigue. You'll know you're fatigued when you start getting emotional in trades. Extended periods of focused attention can lead to mental exhaustion, impairing decision-making, and heightening emotional responses. By stepping away, you allow your mind to reset, reducing stress and regaining clarity. During the break, engage in simple activities like stretching, deep breathing, going on a short walk, or just calling a friend to chat. These actions trigger the brain's relaxation response, reducing cortisol levels associated with stress. Returning to the screen with a refreshed mindset allows for more logical and deliberate trading decisions, fostering a healthier and more sustainable approach. Now, if you're concerned about missing a big opportunity during your break, consider this. In the long run, taking this break will save you more than it will make you. Trading from a place of anger and frustration has not ended well for me, and mistakes made during such times have proven pretty costly. Set your ego aside and take a minimum of a 10-minute break. If you trade through frustration and anger successfully, it will only enforce bad habits. And again, this is something that I had to learn the hard way. Rule 2, a simple risk management rule. I've been asked countless times by new and developing traders whether they should use a fixed position size for all trades. The answer is absolutely not. Different stocks exhibit varying levels of volatility. For instance, Tesla is known for its significant price swings, while Ford tends to be less volatile. Trading the same fixed amount of shares in both cases exposes you to proportionately higher volatility in Tesla compared to Ford. Volatility can lead to larger price swings, impacting your risk and potential profit. A fixed share strategy doesn't adapt to the inherent risks associated with each stock. It can make effective risk management challenging, as stocks with higher volatility might require a smaller size to manage risk effectively, while less volatile stocks may allow for larger positions. First, determine the dollar amount you want to risk on the trade. Identify where your stop is, which is typically based on technical analysis, and then just quickly calculate how many shares you can buy to reach that stop loss level. For instance, if you want to risk $2,000 on a trade and you plan to go long and risk to a previous high or low that's 50 cents away, well, in that case, you should buy about 4,000 shares. This is the way we manage risk here at SMB. Before each trade, our risk is defined and there are almost never any surprises. In addition to that, a simple risk management technique is to average out your last 5 winning days and make that your daily stop loss. This way, you're never losing more than you have the ability to make. I really think that this is a great daily stop strategy for new and developing traders to ensure that they're able to stay in the game. Rule number 3, adhering to your strategy consistently. At SMB, we build chart archives and playbooks for specific patterns we like to trade, such as breaking news, gap and go, a backside trade, and a second day. We study these patterns, mark up the charts, backtest, use technology to alert us to these patterns or tickers where these patterns could show up. Then we wait patiently. Something we often see new and failing traders do is invent trades on the fly. This is a concept Carlton, our risk manager, came up with during a trader review meeting. One trainee took a playbook trade, mismanaged it, and was upset. Shortly after, out of frustration, this trader started chasing every pop purely out of FOMO. Carlton simply asked him, "What trade is that?" There was no answer. It wasn't part of his playbook. It wasn't a play from his playbook or chart archive. It was a trade that was invented on the fly. Sticking to your patterns is crucial. These are strategies you've dissected and understood, your tried and true methods for navigating the market's twists and turns. Deviating from them introduces unnecessary risk. Before executing a trade, ask yourself, what is this setup? If you don't know, save yourself some money and skip it. This leads us to our next rule: patience and discipline. A question I get pretty often is, how many trades do you take a day on average? I have to be honest, I hate this question. If I see my setup appear 5 times in a day, I'll take 5 trades. If I don't see anything setting up for my playbook, then there are no trades for me to take. Day trading is not about meeting some trade quota. It's unique in that you don't need to take a trade every day, especially if there is no setup or edge for you. Never once have I been questioned by my risk manager if I did not take a trade during a session or only took a couple of trades in the span of a few days. This emphasis on patience extends beyond waiting for favorable setups. It's also about waiting for the right market conditions. Markets are dynamic, and not every moment is conducive to successful trading. By exercising patience, I avoid unnecessary risks and ensure that each trade is well considered and aligned with my overall strategy. Here's a fun fact for you. Here on the desk, we did a rough estimate in our monthly review meetings, and we found that the best traders evaluate about 4 to 5 trade ideas for every one trade taken. This means for every 5 trade ideas that come across their screens, they're pressing the keys on just one of them. Discipline is the guardian of consistency in day trading. It involves adhering strictly to predefined rules and not letting emotions dictate decisions. Discipline prevents impulsive actions that can lead to losses. Every trade is a product of careful analysis and the adherence to a set of rules that have proven effective over time. Rule number 5, size down. When confronted with consecutive losing days, the immediate reaction for many traders might be to intensify efforts to recoup losses by taking larger positions. However, this approach can be counterproductive as it amplifies the risk of significant drawdowns and erodes confidence. In contrast, adopting a rule to size down after a predetermined number of losing days demonstrates a disciplined and methodical approach to risk management. If you're on a losing streak, size down until you print a few green days and regain your confidence. Traders at all levels lose some of their edge and consistency at times. Here at SMB, many traders have a rule in place. If they lose 2 or 3 days in a row, they will cut their size until they print a few green days and build back their confidence. I know that's not exciting, but it's a necessary part of trading, especially if you want to do this for a living and have a long career. I know some of the best traders on the street that have gone from a 6-figure daily stop loss down to a 4-figure stop during times when the market is slow or when they are taking on more heat than usual. This practice is not admission of failure, but rather a strategic maneuver to preserve mental capital. It emphasizes the understanding that the market dynamics fluctuate and periods of reduced edge or heightened volatility may warrant a more conservative approach. And lastly, we'll talk about dealing with losses. Losses are an inherent part of trading, and how traders handle them often distinguishes the successful from the struggling. It's all too tempting, especially after a bad day, to simply step away from the screens and try to forget about the loss. However, the path to improvement and sustained success lies in confronting these losses head on and extracting valuable lessons from them. Real traders, those committed to growth and continual improvement, approach losses as opportunities for learning and refinement. Instead of shying away from the discomfort of a losing trade, they embrace it as a chance to analyze their decisions, strategies, and overall approach. The first step is to conduct a thorough post-mortem analysis of your losing trades. This involves asking tough questions like, what went wrong? Were there signs or indicators that I overlooked? Did emotions play a role in the decision-making process? By critically evaluating these factors leading to the losses, traders gain insights into areas that need improvement. The next crucial step is to develop concrete solutions to prevent similar mistakes in the future. This might involve refining trading strategies, implementing stricter risk management protocols, or addressing psychological aspects such as discipline and emotional control. The goal is to create a set of actionable steps that act as a shield against repeating past errors. In essence, treating losses as valuable feedback rather than as failures is a mindset shift that separates proactive, growth-oriented traders from those who stagnate. Every loss becomes a stepping stone toward refining and honing one's trading skills. It's an ongoing process of self-evaluation and adaptation. Successful day trading extends beyond technical skills. It hinges on discipline, resilience, and continuous improvement. The 6 rules discussed form the bedrock of a prosperous trading journey. Remember, losses are opportunities for growth, not setbacks. Incorporate these rules into your routine to safeguard your capital and foster the patience and discipline necessary for navigating the markets. Lastly, all traders need to understand that success isn't avoiding losses, but learning from them. Embrace challenges, stay disciplined, and let each trade contribute to your evolution as a trader.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with S&B to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.